Most investors assume you can't beat the S&P 500 without taking big risks. But what if I told you a simple two-fund portfolio has done exactly that for the past 14 years, finishing with about $639,000 compared to the S&P's $534,000 on the same contributions? That's a difference of more than $100,000. I'll explain why SCHD works as the stabilizer, which 3 growth ETFs compete for the top spot, and then show the backtest results that prove it. But before we get there, let's first ask why the S&P 500 is seen as almost impossible to outperform. Beating the S&P 500 feels nearly impossible because of what the index represents and how it performs over time. You might assume that it's just the average of big US companies, so avoiding the weak ones should make it easier to do better. But here's why it's not so simple. The S&P 500 is already a low-cost, diversified, and remarkably consistent way to capture almost the entire US stock market in a single fund. It covers about 88% of total US market value, and you can own it through something like the Vanguard S&P 500 ETF for about 0.03% in annual fees. That combination of breadth and efficiency sets an incredibly high bar to beat. The challenge gets worse when you factor in human behavior. Most investors underperform the very funds they buy because they let emotions take control. When markets surge, they chase performance, buying in at inflated prices just because the headlines make them feel like they're missing out. When markets drop, they panic sell, locking in losses, while the index fund itself simply rides out the downturn and recovers. Add to that the drag of trading costs or higher fee active strategies, and over years, the gap between what the market earns and what individual investors actually take home grows painfully wide. If you've ever felt your S&P returns were fine but not thrilling, that frustration is exactly the cycle we're addressing. And even though the S&P 500 seems broadly diversified, it isn't perfectly balanced. Right now, mega-cap technologies dominate the index. Apple, Microsoft, Nvidia, and a short list of others have outsized influence, with the top 10 companies making up roughly 38% of the index. That concentration cuts both ways. When those companies lead, the index delivers strong results. But if just a few of them falter, the index feels like it's dragging the entire market with it. Behind the smooth surface of broad diversification, you're actually quite dependent on the fortunes of a handful of stocks and one sector that now makes up more than a third of the benchmark. This structure explains why the S&P feels unbeatable, but also why it isn't necessarily optimized. The index was never designed to win every cycle. It was designed to represent the overall market. Sometimes growth takes the lead, sometimes value makes a comeback, and the S&P shifts weight only as the largest companies gain or lose ground. That's why sticking with only it can feel steady over a long run, but slower than other strategies when a different style of investing is in favor. So the real takeaway is this. The S&P 500 is an incredible foundation, but it isn't invincible. It provides efficient, low-cost exposure, yet its built-in weighing and investor behavior patterns limit how much an individual can get out of it. The key isn't abandoning it, but asking whether there's a way to improve on its balance, pairing its diversification with other funds that shores up weaknesses it can't address on its own. That brings us to the surprising role of dividends. You might not expect a dividend fund to be part of the solution to beating the market, but that's exactly where the story turns next. SCHD, or Schwab US Dividend Equity ETF, earns its place as a powerhouse anchor in a portfolio because of the way it's built. Unlike many dividend funds that simply chase high yields, SCHD tracks the Dow Jones US Dividend 100 Index. That means it focuses on about 100 large, financially healthy companies with proven cash flows, the kind of businesses that can sustain and grow dividends instead of putting them at risk. Each stock has to pass strict screens, so the portfolio avoids fragile companies that might look attractive on yield alone but lack staying power. This approach translates into a fund that investors can rely on both for income and for stability. SCHD currently offers a starting dividend yield of roughly 3.75%, but the real strength lies in the consistent growth of those payouts. SCHD's dividend have increased roughly double digits on longer horizons, roughly 8 to 11% annualized over several multi-year periods. And it has never cut total annual dividends in its 13-year history. That kind of reliability creates a stable foundation of cash flow that doesn't vanish when stock prices fluctuate. For investors, it functions as a stabilizer, historically reducing downside and limiting worse calendar year drops, with its most challenging year at only about minus 5.5%. Keeping costs low is another strength that amplifies SCHD's staying power. With an expense ratio of just 0.06%, investors pay $6 in fees for every $10,000 invested. Compared to actively managed funds, the savings are clear, and more of your returns stay in your account instead of being eroded by management fees. Combined with over $70 billion in assets under management, SCHD offers scale and liquidity that gives investors confidence they can buy or sell without friction. The fund structure also avoids letting any single stock dominate. Individual holdings are capped at around 4% and rebalanced quarterly, keeping the risk of being top-heavy in check. Even though its top 10 stocks make up about 41% of the fund, the weight is reasonable compared to the S&P 500, where the largest companies now carry outsized influence. SCHD also spreads exposure across multiple sectors, including consumer defensives at nearly 20%, energy at around 19%, and technology at roughly 10%. That sector mix provides balance and helps buffer against periods when one industry falls out of favor. The balance shows up especially during market downturns. While growth stocks can swing dramatically with headlines, SCHD diversified blue-chip base and predictable dividends provide steadier performance. In 2022, for example, while broader market indexes suffer double-digit losses, SCHD held up far better thanks to its durable businesses and uninterrupted dividend flow. It doesn't deliver the most exciting spikes on the upside, but it consistently provides the steadiness that lets other parts of the portfolio take on growth without dragging overall results down in bad years. And there's another key advantage. SCHD has very low overlap with growth-focused funds. Importantly, SCHD has low weighted overlap with the growth ETF will test, about 3% with VGT, 5% with QQQM, and essentially 0% with SCHG, so it really functions as a counterbalance. That means investors who pair it with the right growth vehicle aren't doubling up on the same names, but instead are building a portfolio where each piece does something different. Understanding SCHD's role as the anchor sets the stage for the other half of the equation. The question now is, which growth ETF provides the ideal complement? With hundreds of choices available, only a select few pair well with SCHD, and identifying those is the next step. When it comes to adding growth to SCHD, the most effective options aren't endless. In fact, only a few growth ETFs truly complement it without creating unnecessary overlap. That's why the focus narrows to 3 proven candidates: VGT, QQQM, and SCHG. Each one captures growth differently, with its own structure, concentration, and risk profile. Understanding those contrasts is crucial before deciding which fund makes the best partner. VGT is Vanguard's technology ETF, and it offers the broadest reach of the 3. It holds over 300 companies across the entire tech sector, from giants like Apple, Microsoft, and Nvidia, down to smaller firms you might not even recognize yet. That wide scope allows you to capture most of the innovation happening in the US, technology, from semiconductors to software to cloud infrastructure. For investors who want broad coverage across both large and mid-cap names, VGT builds a very large net and makes sure nothing slips through. QQQM takes a tighter approach. It tracks the NASDAQ 100, which includes roughly 100 of the largest non-financial companies in the index. By design, this makes it more concentrated and top-heavy, with the biggest positions accounting for over half of the total weight. It's also important to note that QQQM delivers returns nearly identical to the famous QQQ. It just comes with a lower expense ratio. So effectively, you're buying the same mix of household names that dominate tech and growth benchmarks, only with a leaner fee structure. SCHG, by contrast, is Schwab's large cap growth ETF, holding about 230 stocks filtered with a growth methodology. At first glance, its composition looks very similar to QQQM, given that they share many of the same top holdings. The key difference comes in the weighings. SCHG often takes a stronger stance on its top names. For instance, it may give a heavier weight to Nvidia and Microsoft than QQQM does, while QQQM tends to remain a bit more balanced among its leaders. That subtle shift in allocation can slightly change how risks and returns show up over time. But what makes these 3 stand out as SCHD partners isn't just their growth exposure, it's how little they overlap with SCHD. The numbers are straightforward. SCHD overlaps with VGT by about 3%, with QQQM by 5%, and with SCHG by almost zero. Low overlap means your value anchor isn't simply mirroring the growth fund. So when tech falls, SCHD can meaningfully soften the blow. That kind of diversification you don't get if you simply add another dividend ETF, since most of them share 15 to 20% overlap with growth funds like QQQM or VGT. This is what makes the mix useful. SCHD supplies steady dividends and downside protection, while the chosen ETF provides acceleration when markets reward innovation and risk-taking. It's all about deciding how broad or concentrated you want that growth exposure to be. VGT excels if you want wide coverage across hundreds of tech names. QQQM is best if you're comfortable with more concentration among about 100 leaders that dominate the NASDAQ 100. SCHG falls somewhere between similar names, but with a different weighing style that can tilt performance towards a handful of mega caps. None of these choices is inherently right or wrong, but each creates a different level of risk alongside SCHD's steadiness. The real question is, which one actually delivers the strongest results when combined with SCHD over time? Which of these win in real money terms? The backtest gives a clear answer, and it's not the one everyone expects. Backtest settings. Start $10,000 on January 1st, 2012. Add $1,000 a month, reinvest dividends, rebalance annually, run through August 2025. This setup mirrors what a disciplined investor could have realistically done, not a cherry-picked scenario. The goal was to see what consistent contributions paired with simple rebalancing would look like over nearly 14 years of real market history. Before looking at the two-fund strategy, let's establish the benchmark. Following that exact plan with the S&P 500 alone, via VOO, would have grown the account to roughly $534,000. That's a strong result on its own, but when SCHD is added into the mix, the numbers change in a big way. Here's the breakdown. S&P VOO ended nearly $534,000. SCHD plus VGT ended about $639,000, roughly $105,000 more than the S&P. SCHD and QQQM landed around $595,000. SCHD and SCHG finished around $556,000. Every single combination pulled ahead of the market benchmark by a clear margin. Past results aren't a promise. This is a historical backtest with real past data, not a guaranteed future outcome. The advantage wasn't only in final balances. Not only did SCHD combo produce higher ending values, but volatility metrics were competitive. In one case, SCHG and SCHD, the portfolio posted lower standard deviation than the S&P while still finishing higher. That's meaningful because it points to stronger risk-adjusted returns, not just bigger headline numbers. Look at 2022. Growth-heavy funds fell roughly 30%, while the S&P fell less and SCHD softened those losses. That's where the two-fund mix earned its stripes. Instead of watching massive drawdowns, investors saw setbacks that were more manageable, with dividends still flowing to cushion the ride. Those moments matter just as much as the up years because they shape whether you stay invested or panic and sell. Annualized returns sharpen the picture even further. From 2012 through mid-2025, the VGT blend delivered about 16.7% per year. QQQM averaged 16.2%, and SCHG came in at 15.2%. The S&P trailed at roughly 14.7%. Even using 10-year snapshots, the edge held steady. The VGT pairing stayed at 16.7%, keeping a comfortable lead. Small differences in return rates may sound minor in a single year, but stretched across a decade or more, they compound into life-changing gaps in wealth. Why did this work? Low overlap between SCHD and the growth ETFs, steady dividend growth from SCHD, and annual rebalancing let growth exposure compound while the dividend fund reduced downside risk during tougher periods. Together, that balance produced more growth in the good years and greater resilience in the bad years. The lesson is straightforward. You don't need an elaborate system to tilt results in your favor. By keeping the strategy simple and consistent with disciplined rebalancing, the portfolio gained a measurable advantage over the S&P 500. The growth engines compounded gains, while SCHD provided defense without dragging too far behind in the bull cycles. What this shows is that blending stability with targeted growth creates a durable edge over time. It isn't about timing markets or guessing trends. It's about combining two funds that complement each other's strengths and committing to regular contributions without second-guessing yourself. The second step is to take this insight and think about what it means for your own investing. If beating the S&P 500 is possible with a straightforward formula, the challenge shifts to how you'll actually apply it. Beating the S&P 500 doesn't take speculation or risky bets. It takes discipline and simplicity. SCHD provides the reliable base, while a growth ETF supplies the acceleration. Together, they cover the gaps where the index alone can fall short. Here's a simple three-step plan. 1. Pick SCHD plus one growth fund, VGT, QQQM, or SCHG. 2. Dollar cost average monthly and rebalance annually. 3. Check weighted overlap and keep fees low. Even a 1 to 2% annual edge compounded matters. In the backtest, SCHD and VGT ended near $639,000 versus $534,000 for the S&P, about $105,000 more. Remember, historical outperformance isn't guaranteed. Do your own research, match allocation to your risk tolerance, and consider tax impacts on dividends. If this helped, like so that others can find it, and subscribe for more evidence-first portfolio ideas. Drop a comment with which combo you'd try, or what number in the results surprised you the most.